Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about a couple of stocks that you need to buy now and forget about because essentially the buy and hold psychology is where you buy something that's distressed, hold on to it, and wait for people to forget about the distress event or things of that nature. So you buy something, tend to forget about it, right? Don't think about it, don't check the stock price every day, and then a couple months, couple maybe years later, you come back and it's a nice big gain on your investment. Now we're going to start off with just Google here, because we're looking at Google at once 150 right now, under 110. I'm sorry, at 110, and a company of this size, of this growth, trading at a discount is rare, especially a sizable discount like this one. See, down almost 28%. So Google, not a bad play here, especially after that split. If you can get it at that sweet straight $100, I think that would be a great place to start buying, or around there. I think right now is a great entry. So Google is our number one for today. Next, we're looking at Nike. Nike is one of those stocks also in the Dow Jones with our next pick that I will be talking about. You can see Nike's up from $60 all the way from the COVID low. It was 60, then it hit a peak of 180, and now we are almost approaching near 100. Now that $100 price is also what was hit right back here. You can see just before COVID 2020, $104 is what we are trading at, and right now we're trading at 107. So we're close to that exact same price. Not a bad entry for Nike as well. As you can see, all the earnings reports since then have been positive, which means they beat on earnings, on expected earnings. Rather, they made more than what was expected of them. So Nike, not a bad pick. I like it around 100, but I do think this price, 107, not a bad entry at all. I would consider buying some. Then we're going to talk about CRM, Salesforce, also a company in the Dow. Same type of chart as Nike. You can see 190 hit a low of 117, hit a peak of 300, and kind of tried to recover but fell from 190. We're back at 160, which is around a couple days into the COVID crisis. So not full blown low yet, but we're getting there. So 160, not a bad price, especially considering this company is in the Dow Jones and you're buying it at a 50% discount to the peak of 310. You're buying at 160. So a sizable, honestly, not a bad play if you're looking in the long term. Salesforce, not a bad size position if you could create that in your portfolio. Of course, give yourself some diversification because 50% knockoff in a company this big, it's not too often you see that. And then we're going to talk about two conservative plays where if you have nowhere else to put your money, then buy these stocks, but at the very least, look elsewhere. Verizon, I'm saying that just because these companies don't move very fast. They pay a dividend, and companies that pay a large dividend tend to not grow their earnings very fast or their stock price. So that's what you're trading. For cash flow, you are trading capital appreciation. So in this case, Verizon was once a $60 stock. Now we're trading at 43, the lowest since 2017, and it does pay that nice dividend. We can see right here, 64 cents a quarter. So we're looking at $2.80 a year, more like 5% in this case at this price. So Verizon, 5% or so dividend yield you're buying right off the bat, and it's trading $12 below the high. You're going to add a sizable discount compared to the price now. $12 being, we can see exactly the percentage here, 30%. So lastly, we're going to be looking at AT&T, one of the most hated stocks out there. But that's what you have to do in times like these: buy distressed assets, hold on to them, tell people forget about the distress. So of course, one time AT&T was trading for $33 a share. Now $18. looking at a half in 5 to 6 years, with a couple of, obviously, that's not just because the company's been failing. It's been buying stuff, it's been selling stuff. You can see it's had some mergers and company announcements like that you can't really forecast. But AT&T does have a lot of debt, which means their cash flow is going to be very thin, and their dividend, which supposedly was nice back in the glory days. You can see 50 cents a quarter, but now we're looking at 28 cents, so right around half a quarter, and that's the last 2 quarters. So it's going to be $1 or so a year instead of $2. Your dividend yield was cut in half just because the stock price falling with the not your dividend yield, your dividend payout, but with the company mergers and acquisitions and stuff like that. So AT&T, one of the least liked stocks out there, but we have Google, Nike, Salesforce, Verizon, and AT&T. Verizon, AT&T being the most conservative plays. I would say Salesforce and Nike being the riskiest, and Google being right in the center. Risky is kind of tilted in this scenario because Nike and Salesforce are not risky companies. It's just the most risky out of my picks so far today. So that is the video, guys. I would like to hear what you have to think of these stocks. I think over time, you go in the future, maybe 1 to 2 years, all of these will have recovered at least a little bit, and that's a nice gain, especially if you get Salesforce at 160 and it goes back to 200. Well, you just made a 20% plus return in a very little time span. Or Nike goes from 100 to 150, that's 50%. Google fully recovers from 100 to 150, that's another 50%. So stocks don't have to move very much once they have fallen so much to fully give you a sizable percentage in your portfolio, and that's what you have to learn during this so-called recession. Thank you for watching, and until next time.